Module 1. The Invisible Giant. Close your eyes for a moment. Imagine a world where money never sleeps. Where borders are invisible, and every second, somewhere on this planet, a transaction worth millions is happening in complete silence. While you are having breakfast in New York, a pension fund in Singapore is buying European bonds. While you are sleeping in London, an oil tanker in the Middle East is settling a deal in US dollars. While a child is being born in Mumbai, a tech company in San Francisco is paying salaries in 15 different currencies. This is the Forex market. $7.5 trillion. Not per year, not per month, per day. To put that in perspective, if you combine every stock market on Earth, the New York Stock Exchange, Nasdaq, the London Stock Exchange, all of them together do not even come close to 1/5 of Forex's daily volume. But here is what most people do not understand. Forex is not just a market for traders. It is the bloodstream of civilization itself. Every imported car, every international flight, every grain of coffee from Colombia, every iPhone from China, they all pass through this invisible river of currency exchange. Without Forex, global trade dies. Without Forex, your morning coffee does not exist. This is not a casino. This is the engine room of the modern world. And you are about to learn how it works. Module 2. The language of pips and lots. Before you can trade, you must learn the language. And in Forex, there are 3 words that separate amateurs from professionals: pip, lot, and leverage. Let us start with the pip, the heartbeat of Forex. Look at this number. 1.0850. This is the EUR/USD exchange rate. 1 euro equals $1.0850. But watch what happens when the market moves. That tiny change, from 1.0850 to 1.0851 is 1 pip. The smallest measurable move in most currency pairs. It is 1/10,000th of a unit. In Japanese yen pairs, it is different, just 2 decimal places, like 149.50 to 149.51. But the principle is the same. 1 pip is the pulse, the market's heartbeat. Now, here is where it gets real. If you trade 1 standard lot, that is 100,000 units of currency, then every single pip you move equals $10 in profit or loss. Move 10 pips, that is $100. Move 100 pips, $1,000. But most beginners do not trade standard lots. They trade mini lots 10,000 units, where each pip equals $1. Or micro lots 1,000 units, where each pip equals 10 cents. This is your volume control. This is how you manage risk. But then, there is leverage. Leverage is the most misunderstood concept in trading. Beginners think it is free money. It is not. Leverage is a magnifying glass. With 100 leverage, your broker lets you control $100,000 worth of currency with just $1,000 of your own money. That means every pip movement is magnified 100 times. Move 10 pips in your favor. You make $100. Move 10 pips against you. You lose $100. Leverage does not just amplify your wins. It amplifies everything. It is the power to move a mountain with a pebble. But remember, if that mountain falls, it falls on you. The professionals, they use leverage like a scalpel. Precise, controlled, calculated. The gamblers, they use it like a sledgehammer. And eventually, the market hammers them back. So here is your first rule. Respect the math. Calculate your lot size. Know your pip value. And never let leverage seduce you into risking more than you can afford to lose. Module 3. The hierarchy of pairs. In Forex, currencies never fight alone. They always come in pairs. And understanding this relationship is everything. Meet your USD, the most traded pair on Earth. The euro is the base currency. It is the boss, the leader, the one in control. The US dollar is the quote currency. It is the price tag, the follower. When you see your USD at 1.0850, what does that mean? It means 1 euro costs 1.0850 US dollars. The base sets the value, the quote tells you the cost. When you click buy on your USD, you are buying euros and simultaneously selling dollars. When you click sell, you are selling euros and buying dollars. You are always taking both sides of the trade. This is the fundamental grammar of Forex. But not all pairs are created equal. There are majors, the popular kids. Your USD, GBP, USD, USD, JPY. These pairs are liquid, meaning there are millions of buyers and sellers at any moment. Why does that matter? Because liquidity equals low cost. The spread, the difference between buying and selling price, is tiny. On your USD, it might be just 0.1 pips. You can get in and out cleanly, like a knife through water. Then come the minors, also called cross pairs. No US dollar involved. Your GBP, AUD, NZD. Still liquid, but slightly wider spreads. Still tradable, but you need to be more careful. And finally, the exotics. These are the wild cards. USD TRY, US dollar versus Turkish lira. Your ZAR, Euro versus South African Rand. These pairs are volatile, unpredictable, and expensive to trade. Why expensive? Because the spread can be 20, 30, even 50 pips wide. Before you even make a profit, you are already in the red. Unless you know exactly what you are doing, exotics will eat you alive. So here is your second rule. Start with the majors. Master the fundamentals on your USD and GBP USD before you even think about touching exotics. Module 4. The trading clock. The Forex market never closes. 24 hours a day, 5 days a week, somewhere on earth, currencies are moving. But here is what they do not tell you in the YouTube ads. Just because the market is open does not mean you should be trading. The market has a pulse, a rhythm, a personality that changes every few hours. Watch. The day begins in Sydney, Australia. The Asian session awakens. Volume is low. Movement is slow. It is like the market is stretching, yawning, waking up from sleep. A few hours later, Tokyo opens. Suddenly, the Japanese yen comes alive. Institutional traders in Singapore and Hong Kong join the game. But it is still relatively quiet, more like a conversation than a battle. Then, at 8 a.m. London time, everything changes. London opens, the financial heart of Europe. Trillions of dollars flood into the market. Volatility spikes. The calm ocean becomes a churning sea. But the real magic happens at 1 p.m. London time, 8 a.m. New York time. The London-New York overlap. For 4 hours, from 1 p.m. to 5 p.m. London time, both financial giants are awake and active. This is when 70% of all Forex volume is traded. This is when the biggest moves happen. This is the golden hour. If you are going to trade, this is your window. Then, as London closes, New York continues alone. Volume drops. Volatility fades. By 5 p.m. New York time, the market is winding down, passing the baton back to Sydney. And here is the brutal truth. The hours in between are ghost ships. Between the close of New York and the open of Tokyo, what traders call the dead zone, the market drifts. There is no volume, no momentum, no institutional interest. Trading in the dead zone is like trying to sail a ship with no wind. You will burn energy, waste time, and get nowhere. So here is your third rule. Trade the overlap. Respect the sessions. And never trade just because you are bored. The market does not reward activity. It rewards timing. Module 5. Setting up your lab. You have learned the language. You have understood the clock. Now, you need to build your laboratory, the place where strategy becomes action. And there are 3 essential tools every serious trader must have. First, your broker. Your broker is your bridge to the market. They hold your money. They execute your trades. Choose wrong, and you will face withdrawal problems, manipulated spreads, or worse, complete fraud. So how do you choose? Look for regulation. Is the broker licensed by the FCA in the UK? The NFA in the US? ASIC in Australia? These are the gold standards. Check the spreads. On your USD, you should be paying no more than 0.5 to 1 pip. Anything higher, and you are being robbed. And read reviews, real reviews. Not the sponsored ones. Find traders who have withdrawn large sums successfully. That is the real test. Second, TradingView, your map and telescope. This is where you think, where you analyze, where you identify opportunities. TradingView is the most powerful charting platform on earth. Clean interface, unlimited indicators, the ability to backtest strategies and save your ideas. This is your war room. This is where you study the battlefield before you enter it. Third, MetaTrader 4 or 5 your cockpit. This is where you execute, where you pull the trigger. MetaTrader is the industry standard for order placement. It is fast, it is reliable, it is boring, and that is a good thing. You do not need flashy. You need functional. Here is the key distinction beginners miss. Separate your thinking from your doing. Analyze on TradingView. Execute on MetaTrader. Never let the temptation of a live chart rush you into a bad decision. This is your lab, your sanctuary, the place where preparation meets opportunity. Respect it, keep it clean, keep it organized, and never let emotion enter this room. Module 6. The Blueprint. So let us review what you now know, what 90% of beginners skip and why 90% of beginners fail. You understand the big picture. Forex is not a casino. It is the bloodstream of global trade, the engine of the modern economy. You speak the language, pips, lots, leverage. You know how to calculate value and manage risk. You know the hierarchy. Majors are your home base. Minors are your advanced playground. Exotics are the wilderness. Enter only when you are ready. You respect the clock. You trade the overlap. You avoid the dead zones. You understand that timing is everything. And you have built your lab. A regulated broker. TradingView for analysis. MetaTrader for execution. This is phase 1. This is the foundation. And here is the truth they will not tell you in the get-rich-quick ads. You do not need luck. You do not need a secret indicator. You do not need to trade every day. You need a blueprint. If the foundation is solid, we can build the skyscraper. If the foundation is weak, the whole thing collapses. In phase 2, we will build the next floor. Chart reading, price action, and the art of seeing what others miss. But for now, take a breath. Absorb what you have learned. Because you are no longer a beginner. You are a builder.